Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. Thank you for tuning in, spending a part of your day to be here. And I've actually got something of an emergency video for you today. I've just found a stock signal that's pointing to a stock market crash later on this year and some major challenges to any higher returns. So for this video, I'm going to reveal that signal, when it's going to hit stocks, and then towards the end of the video, I'll give you 3 strategies to protect yourself from the coming crash. So make sure you stick around for that. And I know what you're thinking. Oh, he's talking about the coronavirus popping up again in the fall or some stock crash signal in the yield curve. That's not it. This is totally unrelated to the COVID-19 and a signal that nobody is really talking about right now. I'm talking about the VIX volatility curve. Now, the VIX is a measure of stock market volatility, how much the S&P 500 is bouncing around on a daily basis. Now, for the past few years, the VIX has traded around 10, while the market did nothing but move higher. Then we see this monstrous surge higher on the coronavirus when we had those market swings of 7% or more on a daily basis. Lately, of course, the VIX has settled down a little bit into that range around 30, but it's still about 3 times higher than where it started the year. This, of course, is just telling us that investors still see the market as extremely risky. More telling, though, is this VIX curve. So investors can buy futures bets on the VIX, that volatility index, and basically you can say, I want to buy a bet on the VIX if you think that that market risk is going to return. So that bet pays off if the market goes batshit crazy again like it did in March. And you can buy these bets in different months, just like stock options. So you can buy or sell a futures contracts on the VIX for July or November or January, depending on how long you think it's going to take for that volatility to come back and when you want that bet to be in place. Now, traders can use this curve to see when investors think that there's a lot of risk in the market. Here we see the VIX curve, and in normal times, this would be sloping upwards because investors always want that higher premium to take longer term risks. What we see, though, is the risk in the market is high over the next few months, obviously because of the fear around the virus, but then it jumps higher in month 6 before falling off. And now research by Credit Suisse has looked at other foreign markets and found no similar bumps in that volatility futures curve. So both the European Stocks 50 and the Nikkei 225 index, both those curves were flat on that 6th month. Of course, when we look 6 months out in the United States, we find that 2020 election and what could be a major risk for investors. Now, before you scroll down to leave that hate comment or just close out the video, this is not going to be political. Okay, all you in the Bowtie Nation know, I've never made this channel political. I'm just reading the market and telling you what it's saying. And what the market is worried about here is that repeal in the corporate tax cuts we saw in 2017. And for better or worse, those tax cuts for companies were huge for earnings. You can argue whether the cuts made it any better for regular people, but it was undeniably good for corporations and investors. You just look at this 21% surge in corporate profits in that first full year after the cuts. Now, again, I don't want this to be political, okay? I probably shouldn't even be telling you this, but I'm actually a registered Republican, but have voted about 50-50 Republican Democrat since 2000. I'm not saying who's going to be better for the economy or for the nation, just what the market is afraid of here. And let's be honest, folks, we're looking at a $4 trillion plus deficit this year. Okay, that's $4 trillion. The United States is in debt up to its eyeballs, and just about every government program is underfunded. Taxes are going to need to go up in the future. They will need to go up in the future. And, whether that means increased taxes on corporations or individuals, you're going to get one or the other, or probably even both. So don't think that voting Republican or Democrat is going to save you from either here. Now, the only difference is that the market is betting that maybe a Republican administration would fill the gap with higher personal tax rates. So like letting those tax rates fall off for the individuals like they were scheduled to do in 2025. So if you don't remember, when that 2017 tax cut reform was passed, the corporate tax cuts were permanent, right? Those were indefinite, while the personal tax cuts are scheduled to go out in 2025. So our personal tax rates are scheduled to go back to where they were in 2025. And the market is just betting that, Republicans would fill that $4 trillion tax, budget gap with, letting those personal tax rates expire, whereas maybe a Democratic administration might look for some of that money from corporations by repealing some of those cuts that were made permanent. But now back to the markets, and what does this mean for you as an investor? Okay, David Kostin, he's the chief U.S. equity strategist at Goldman Sachs. He estimates a potential drop in 2021 earnings per share of $19, which would mean about $147 per share on those analyst estimates. That would mean stocks are right now trading at 20 times forward earnings. And that's assuming that those earnings are as high as estimated. I'm actually thinking they're closer to 160 in 2020 earnings without that drop pullback. So $19 off of that even. Now, with some of the risks we'll talk about already in the markets, and as expensive as this stock market is trading, just the possibility of seeing some kind of tax increase is all that's needed to send investors to the exits. The stock market has surged from its lows, and whether we see a big crash or not, stocks are just going to have a very tough time going much further through October. You have that election risk hangover, as well as a fear of a potential second wave of the virus when that flu season starts again in October. Most companies have withdrawn their forward guidance on earnings, so investors are pretty much flying blind here with just no idea on how profits are going to be until those second quarter reports start coming out in July and in August. Now, this is all going to mean a flat market at best, and it won't take much to send us down another 10 or 15%. So I want to share 3 ways to protect your investments, maybe even make a little bit of money in the process. Now, I'm primarily using options to protect my portfolio here. We've done a couple of videos on the channel about covered calls and protective puts, so I'll leave a link in the video description below for those. And selling call options against stocks you own, or called that covered call strategy, that just means selling another investor the right to buy those shares from you at a specific price at a specific date in the future. Now, for that right, you collect some money now. For example, if I own shares of Apple, which are trading here at around $315 per share, but I'm worried that the stock might fall, I can go here to the January 2021 options and I can sell someone the right to buy those shares from me for $320 each if they pay me that $30 premium right now. So I'm going to collect $30 a share for every share of Apple I own. If the shares do rise above that $320 strike price by January 2021, that investor is then going to take my shares for that price. If, though, the stock price does fall, as I fear it will, I keep the shares and that $30 premium on the options. And this is a great strategy in a falling or sideways market because you're going to be able to keep those shares plus the premium. With the volatility still pretty high, you can easily get maybe a 10% cash premium on a lot of your stocks. And if they don't run much higher, those options are going to expire worthless and you'll keep the shares. Now again, options investing can be a little confusing at first, so check out that video that I'm going to link to in the video description below. Next is, if you're looking for protection, your best bet is just going to be positioned in some of those safety sectors of the economy. And we can look at a chart of the sector returns year to date to get an idea of what some of those are. So here we see the market has fallen about 9% since January, but a few of these sectors have done relatively well. Now, I think consumer staples, healthcare, and utilities are probably going to be your best bet, with all 3 sectors outperforming the market year to date. I do think you need to be careful with technology and communication services, though. While both have done really well during the pandemic because sales aren't expected to fall as hard, they might not be your best protection from any election risk or a deeper economic risk. And both of these groups are high tax sectors, so they really made out in those 2017 corporate tax cuts. So any rollback to those higher tax rates definitely going to hit these 2 sectors. And another strategy I'm using for near and even long-term protection is buying gold, both physical gold and that Spider Gold Trust ETF, ticker GLD. Nation, gold has a lot of ways to win here. Okay, first is just that store of value and the protection in the stock market crash. Even when investors started selling everything they could in March, in that mid-March sell-off, shares of the Spider Gold Fund only fell 4% versus that 30% plunge in stocks, and now gold is back up to positive on the year. Next though, and this is a little bit of a longer term idea, but investors could finally need an inflation hedge. The government is borrowing like it's going out of style, printing more than $3 trillion for the stimulus bills and another trillion for just the normal government spending. The Fed is throwing even more at this, exploding its own balance sheet to $6.7 trillion this year. The bill comes due, folks, and it's going to come through in a weaker dollar and higher inflation. So you better have assets that can keep up with inflation, like gold and like real estate. Click on the video to the right for 3 dividend stocks I'm buying in May. 3 safe stocks with dividend yields of 5% and higher. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.